Today, I'm going to be looking at what the cost of living crisis means for the longer term. I'm Laura Suter, Head of Personal Finance at AJ Bell, and I wanted to today really look through what the cost of living crunch means for people's finances right now. Then we're going to look a little bit at some of the cutbacks that people are making beyond the obvious kind of budgeting cuts, including some research that we've done into this area. And then looking at the long-term implications of those savings and cutbacks, and then some talking points at the end for advisors that might be for their clients or for their clients' children, because one of the areas we're going to look at is how younger people are being affected by the current cost of living crisis. So if we just set the scene a bit with the cost of living crunch, I'm sure everyone has seen a lot about the cost of living crunch at the moment. It's been impossible to avoid it. It's become front page news, which is quite interesting for us. So previously we would cover figures like inflation, and that would be very much a news story for the business section. It's now front page news what inflation is each month or what the Bank of England is doing, and clearly the government has come with a response to that with various levels of support for different households. But what we're really seeing is that energy costs have gone up, food costs have gone up, and all of that is driving inflation up and causing a real crunch for households. So let's look at some of the figures behind that. So at the moment, we've got inflation at 9% at the latest reading for April, which is a 40-year high, but it's going to go higher than that. So there's expectations that it's going to hit double digits this year, and that it's going to probably go to 11% or even higher this year, which represents a massive increase in costs for individuals. And a large part of what's driving that is energy costs. So between March and October this year, energy bills are going to increase on average by £1,500. So that takes into account the April increase in the energy price cap and the October increase. And if we think about that as an addition to household bills, where energy costs have already gone up last year and they could rise again in January, that's a big increase for a lot of households. And it's also worth pointing out that that 1,500 figure is the average for households. Households where there's lots of people there, or they're a particularly energy inefficient home, or where they're more energy intensive, so they spend more time in their home, like pensioners or disabled people, for example, will be facing much higher rises. And what we're also seeing is there's been lots of talk about the fact that we're in a high inflation time, but those that were around in the 70s will be aware that actually it was much higher then. But what we've got is a very big gap between inflation and interest rates. So in the 70s, when inflation was very high, interest rates were also really high. Because the path that the Bank of England has chosen to take of only moving towards the end of last year on raising rates, and when they've raised rates, only doing it by small increments at a time, it means that we've got inflation running much higher than the increases in interest rates. So that gap is very big. And all of this means that people are taking on more debt. So when we look at the figures for the previous 3 months, £3 billion was added to credit card debt. Now, for some context, when we look at that, what we saw in the pandemic, when lots of people were saving money, is that figure would have been a minus figure. So people were not only not adding to their credit card debt in a month, but they were actually paying off their balances. So what we've seen is a very big switch from even a year ago, where people were repaying balances, and now as a nation we've added £3 billion onto our credit card debt. And it's worth pointing out that there's lots of other debts that we've added to as well, whether that's personal loans or things like store cards, but also more informal debt. So lots of people borrowing off family and friends, or borrowing from much more unscrupulous lenders, where they'll be paying far higher interest rates. And the big increase with the Bank of England increasing interest rates, the impact is on the mortgage market as well. So if we look at the best buy rates that you could get in the mortgage market, for a 75% loan to value fixed rate mortgage, it's gone from just over 1% last year to above 2% now, and actually it'll probably be higher than that 2.35% figure there now, because the Bank of England has increased interest rates again. And so we know that lots of people, about 85% of mortgages today are on a fixed rate rather than a variable rate. So lots of households aren't getting hit immediately by the Bank of England interest rate rises. But what it means is that when people come to refinance their 2-year mortgage or 5-year mortgage, for example, they're going to be refinancing at much higher rates. And what they'll be doing is seeing the impact of all of those Bank of England rate increases in one go rather than seeing it incrementally. And that's going to have a big impact on what people can afford and their mortgage costs each month. But what we do have is a very divided nation. So if we look at the inflation of the poorest 10% of society, inflation is about 11% for them, and for the richest 10% it's about 8%. And actually that gap is expected to get worse over coming months. And that's really because the poorest households spend far more of their money on things that have risen in cost, so energy and food bills. They also spend lots more of their money on those essentials rather than discretionary or luxury spending that they can cut back on. And so that means that the real inflation rate for those poorer households is much higher. And while I talked about people adding to debt earlier, we've still got people saving money. So we've still got people who are facing these higher costs of living, but are still managing to put away money. So if we look between Jan and April this year, 26 billion was added to household savings. So there's a real divide here. And I think part of that is how people came out of the pandemic. If you were someone who got furloughed or lost their job or saw their income fall during the pandemic, you probably already had to dip into your savings and you came out of the pandemic with no additional savings and not in a great financial position, and then you've been hit by the cost of living crisis. You're going to be struggling much more than someone who didn't see any reduction in their income during the pandemic, who maybe could work from home, who saved a lot of money, who didn't go on expensive holidays and could stash a lot of money away during that time. And so I think we've seen that pandemic divide continue into the cost of living crisis about how financially resilient people are going into that. And then what we've also seen is savings rates increase. So those people that do have cash savings are now getting a higher return on their money thanks to Bank of England interest rate rises. Although it's obviously worth pointing out that those cash rates are nowhere near what inflation is now. But still, those people that managed to save money during the pandemic have seen an increase in their return that they're getting. And so what we see is the areas where people are really hit are pensioners, single parents and disabled people who've been hardest hit. And those are people that tend to spend more of their money on energy and food and those essentials. So for example, disabled people often have to run equipment that's very energy intensive. And they're also people that don't have as much control over their income. So they may be on state benefits or on state pension. And so they don't have that ability to kind of negotiate their income up. So I thought it would be useful to run through some of the government support that's been on offer. We've obviously seen that announced in various different tranches. So I think it would be useful to go through all of the support that different households are going to be getting. So first off, we've got the £150 council tax rebate, and that has gone to every family who has a property in bands A to D. Now, most people will have been paid that already. That will have gone already to people that pay by direct debit. There was a slightly longer, more drawn out process for those that didn't pay their council tax by direct debit, but most people should have seen that money that were eligible for it. The next bit of support on offer from the government is the £400 energy bill rebate, which they're calling the Energy Bill Support Scheme. So that initially was going to be a £200 loan where you got it this autumn, and then you had to repay it back over a period of 4 or 5 years. However, and it was also going to be, £200, so half what we're seeing now. The government has now scrapped the fact that it's a loan and it's made it a grant, and also doubled the amount of money. So every household will get this £400, and it comes through your energy bills. So it will come through your electricity bill, because not every household in the UK is connected to gas. So it will come through your electricity bill, and it will come as a rebate on your bill. So the next bit of support that was announced is £650 for those on universal credit. So that is about 8 million households that are on means tested benefits, and it includes things like universal credit, but also things like income-based job seekers allowance, income related employment and support allowance, income support and pension credit. And so that's split into two different payments. The first payment is going to be in July. It'll be in the kind of second half of July, and that will be for £326. And then the remaining amount of money will come in autumn, and the government hasn't set what date or what exact month that will come. The reason for it not being exactly half this time around is the government wants to prevent fraud. I'm not 100% clear on the details behind that, but it means that the first amount will be that 326, and then you'll get the remainder later on in the year. The next bit of support, because there've been a lot of commentary around how pensioners had been really hit hard in the cost of living crisis until the latest announcement from the government, there hadn't been any specific support for pensioners. And obviously the government had scrapped the triple lock, which meant that pensioners got a below inflation pay rise effectively in their state pension. And so the government responded to this by announcing an extra £300 for all pensioners in receipt of the winter fuel payment. So this hits pensioners' bank accounts in November or December, and it's not a means tested benefit. It goes to all pensioners. So that means all pensioners, regardless of their income, who were eligible for the winter fuel payment will get extra amount of money. However, crucially, that £300 is per household, it's not per individual. I think there was a lot of confusion when the government announced these plans and everyone thought all of these figures were per individual when lots of them are per household. So if, for example, the winter fuel payment will be £600 this year for someone who lives alone and is over the age of 80. There's two different rates for the winter fuel allowance, one for over 80 and one for under. Those over 80 get slightly more. Or another example is it's £250 per person for a couple who live together who are under the age of 80. And then there's a smaller payment. So if you live in a care home, you'll get a lower amount of £250 if you're under 80 and £300 if you're over 80. And that's just to reflect the fact that your energy costs are kind of shared with other people because you're living in a care home. So it's a much bigger payout for pensioners this year. And that automatically gets paid out in the same way that the winter fuel allowance does. The next bit of support from the government was £150 for disabled people. So this is people on various disability benefits. This is to reflect the fact that lots of disabled people will have higher energy bills. They might have specialist equipment that runs on electricity, or it might simply be that they just spend more time in their home. And so those individuals will get £150. It's worth pointing out that you can double up on a lot of these. So lots of people obviously will get the £150 council tax rebate and also the £400 energy bill support. But if those individuals are pensioners, for example, they will get that on top of the £300 winter fuel allowance. And then, for example, if they also had a disability that made them eligible, they'd get that extra top up. So it could be that you are eligible for all of these payments and you would get the maximum amount, but it's definitely worth checking out specific circumstances. And for those advisors dealing with clients, it's worth checking out what they'll be eligible for. And then the final kind of less clear support announced by the government is a household support fund. So this is total funding of £1 billion, although some of that has been spent already. And this is money that's given from central government and filtered down to local authorities to hand out to people in their communities. This is a little trickier because the guidelines for who's eligible for it vary, and it will depend on the local authority's interpretation of who's eligible. There are some guidelines from central government. There's a particular focus, for example, on households with children and also on pensioners. So a third of the money should go to each of those groups, with the remaining third then going to kind of general population who are struggling, particularly with food or water or energy bills. As I said, the first tranche of this money has already been handed out. The second tranche was announced earlier this year, and that's £421 million that's being handed out between April and September. In reality, Obviously, once that's filtered down to local authorities, it's a much smaller amount per local area. And in reality, a lot of this money has already been spent. Some local authorities would have spent it very quickly because the need was higher. For people to claim this is a little trickier because there's not a clear guideline like there is with the other support. And so it's a case of, if you think that you might be in need, going to your local council website and seeing if they've got a criteria of who might be eligible, or speaking to organisations like Citizens Advice, who might be able to point you in the direction of how to claim some of this money. And the form of it comes in different ways. So some local authorities are using vouchers, some are using actual cash that goes into your bank account. So it kind of varies a bit, and it's very local specific. So I thought now we could go on to looking at the cutbacks that people are making. And so obviously people are having to make some cutbacks. And I think if we just look at more general cutbacks to start with, people have really been looking at their budgets and they've been assessing where they can save money each month. And unsurprisingly, a lot of that kind of discretionary spending is happening, is being cut back on, sorry. And so, for example, so Nationwide produced some really interesting research. It's their kind of spending report, and it analyzes all of their customers' spending data and assesses it against the previous month and the previous year, and looks at spending patterns and how they change. So it's a really useful insight into how people are budgeting and where people are making cutbacks. There's a few examples here on this slide. So there's been a 16% reduction month on month in people giving to charity, which makes sense. If you're really struggling financially, then charitable donations are probably going to be one of the earlier ones. Interestingly though, even though charity spend is down month on month, it's actually still up year on year, as people are still looking to support. And I think that probably reflects the fact that people that do have a bit more money know that there's people in need out there, and maybe want to donate to their local food bank, or to people that can help those struggling with the cost of living crisis. There's been a big cutback in subscriptions. So these are things like, we've all signed up to lots of streaming services in lockdown, and it's people cutting back on these, assessing whether they really need all of those subscriptions, or where people have had free trials and now it's rolled over into them spending money. It's about kind of cutting back on that. So there's been a 10% cut back on subscriptions, and actually there was some different data out from an organisation called Kantar, which said that in the first 3 months of the year, more than 1.5 million households cancelled accounts for services like Disney Plus or Now or Apple Plus. So all of those kind of subscription streaming services. And I think it makes sense. People are assessing whether they really need to pay out that kind of 8, 10, 15 pounds a month for that service if they're not using all of them. Interestingly, childcare was another big area where people were cutting back. So there was a 23% reduction in the amount of money spent on childcare. Some of this reflects, this data was gathered in April, and that reflects partly the Easter holidays, but it's also, childcare is a massive cost for a lot of families, and with some people still working from home, they're able to cut back on those childcare costs. And then a massive figure, which I think probably doesn't surprise people, but we've seen a 40% increase in spending on bills and utilities, which is really kind of council tax increases kicking in that month, but also the energy price cap changed in April, and so that pushed people's bills up. And that's where a lot of the additional spend is coming. So just the final area to mention is probably there was a big increase in the amount that people spent on motor fuel, so petrol and diesel, as we all saw those costs at the forecourt rise. So then I thought it would be useful to look at the cutbacks. So lots of people obviously have made budgeting cutbacks, or they've cut back on subscriptions or some of the luxuries, and that's understandable. But we wanted to delve into some of the longer term impacts that there might be on people making cutbacks. So when we looked at it, we questioned people about whether they've made cutbacks to their pensions or their ISA or lifetime ISA contributions. And what we saw was quite a big divide in the age groups. So if we look at 18 to 34-year-olds, 15% have already cut back on their pension contributions, and a further quarter are considering that as an area to make cutbacks in the future. So what we know from the cost of living crunch now is that prices are rising now, but those price increases aren't stopping, and it looks like The winter this year is going to be particularly tricky for lots of families as energy costs are rising even higher. And so people have already lined up pensions as an area to cut back. But if we look at that and then we compare it to the next age group up, so 35 to 54-year-olds, far more younger people are making those cutbacks than older people. So just 10% of that older age group have made cutbacks, and 11% are considering it in the future. There's probably a couple of reasons for that. Partly younger people have less financial resilience. They haven't been working for as long, so they haven't been able to build up as much in savings. So they'll need to make those financial cutbacks sooner, but also they're further from retirement, they're further from using their pension, and so therefore it feels like an easier cutback to make because it's something further in the future, the implications of it. So it's interesting to see that. And then we also asked about ISAs, and we saw a broadly similar thing. So 16% of those in the 18 to 34 group have cut back on their ISA subscriptions already, and a further 22% are thinking about it. And the figures for the over 55 age group, for example, are much lower when we compare them. And so I think it'd be interesting to look at the implications of that. So when we consider that, there's a lot of kind of text here, but I'll talk through a bit of it. So if we take those pension cutbacks first, and we assume that there's a 30-year-old who's on a salary of £30,000 and they're contributing 8% to their pension. Now that's the contribution between them, their employer, and tax relief. So that's the auto enrolment minimum. If they paused those pension contributions for 3 years, so during this cost of living crunch, they paused it for those 3 years, then that could cost them £15,000 in their pension. So that has a big impact on their pension pot in retirement. And then I think it's also useful to look at how long it would take to make up that shortfall. So if you wanted to make up that shortfall in the following years, you'd need to increase your pension contributions to more than 10% of your salary for 5 years in order to get back to the position you would have been if you hadn't made any cuts. And if you wanted to reduce that time period to 3 years, so you wanted to get back to where you were within a 3-year period, you'd have to increase your pension contributions to 12%, which for lots of people might not be an affordable level, particularly if you're not getting employer matching all the way up to that limit. So there are big implications of making these relatively easy cutbacks now. We also looked at the impact on lifetime ISAs. So with a lifetime ISA, you can put £4,000 a year into it, and then the government will top it up by another £1,000. But it's a use it or lose it scheme. So if you don't put the money in that tax year, then there's no ability to go back and get that free government money. So for someone who's saving for a house deposit and they were putting in £4,000 a year into their lifetime ISA, and they pause that contribution for 3 years, then that would leave them £21,000 worse off when we look at that over a kind of a 10-year period. So, and we assume investment returns of 4% a year. So that's really the impact of not putting those savings in, not getting that government top up, and then not getting the investment returns on that money during that time. And so I think this just helps highlight some of the long-term implications of making what would seem to be quite a quick, easy decision now to make those cutbacks. I think it's also worth pointing out that lots of people might think, particularly with pension contributions, that it's just going to be a temporary thing, just to get them through the next few months or to get them through the next winter. But it's very easy to then forget to resume those contributions, and that what you intended to be a 3-month gap becoming a year or 2 years or 3 years. There's always a reason where you might need money elsewhere in your life, and actually reminding yourself to make those contributions again, it can be a bit tricky. So for those that do make cutbacks, it's a good idea to put a reminder in 3 months' time, 6 months' time, to check back in and say, restart these contributions if you can afford to now. But some positive stats from the research that we did is that women are less likely to be making cutbacks compared to men. There's a bit of a caveat to this, but I'll come to it at the end. But the positive stuff is that if we look at people that have a pension, fewer women than men have already made cutbacks, and fewer women than men are considering making further cutbacks to their pension in the future. So women are really preserving those pension and ISA contributions. So when we look at the ISA figures, as you can see here, the figures are slightly closer in terms of, so 23% of women have made cutbacks to ISA compared to 20% of men. But women are more reluctant to make those cutbacks. The caveat that I mentioned is that this is rebasing the figures to look just at those making pension contributions and just at those making ISA contributions. In reality, far more men than women are making pension and ISA contributions for lots of different reasons that we've talked about on Luminary before. So while women are doing better and they're preserving those savings, there are on balance fewer women making those savings in the first place, but still is a bright spot that the women that have made that commitment to put money in their ISA or put money in their pension are trying to ring fence that and preserve that more so, which is really important. So I thought it would be useful now to look at some of the talking points that you can touch on when speaking to clients. So obviously we've looked a bit about younger generations, and so a lot of these conversations might be things where you're prompting your clients to have those conversations with their children or younger people in their life, or it might be that you already have a relationship with your clients' children, and it's kind of maybe even if it's more informal and it's kind of reminding them of those. But anyway, let's go through. So the true cost of making those cuts. So some of the examples that I talked about there, and also bringing to life how long it takes to recoup that money and to get back to your starting point is really important to highlight that, because I think if you are younger, say you're in your 20s, you feel like money's a bit tight, it can be a really easy thing to just cut your pension contributions and worry about it later. But actually, if you can put real facts and figures around, okay, so cutting that amount of money each month is actually going to cost you this amount in the long term, really helps to bring it to life. And also highlighting the fact that if you're cutting those pension contributions, you're not getting that tax relief, you're not getting that free money from the employer. And so that means that you're leaving free money on the table, you're leaving an effective kind of free pay rise on the table. Another area, I mean, we touched on the fact that pensioners have been hard hit in the cost of living crunch. There hasn't been specific help from the government for pensioners until the latest tranche of help. And they are people that spend more money on energy and food. They tend to spend more time in their home, particularly when they get older, but also they face the same issue that the rest of the nation does, in that if costs are rising, they either need their income to increase or their costs to fall. Now, pensioners have it a bit harder, because if you're in work, you can get a new job, you can ask for a pay rise, you can take on some additional hours maybe, or start a second job on the side. For lots of pensioners, that's not an option, particularly those that are taking money from their pension and relying on the state pension. And so it's really about highlighting, if they decide to take more money from their pension rather than cut their costs, the impact that that's going to have over the longer term on their pension portfolio. So how many years is that going to shave off? Because even a relatively small increase, particularly if they're early on in their retirement, can have a really big impact on the long-term wealth and how much money they're going to have left when they're older. And then it's about engaging kind of clients' children in the conversation, so talking about ISAs and LISAs and the importance of preserving that money so that you don't cause this hopefully short-term cost of living crunch to have much longer-term implications. And also highlighting the impact of dipping into investments and savings. So we touched on the fact that lots of people came out of the pandemic with lots of savings and money, and it can be easy to just dip into that very easily now because you've built up that pot, and that's exactly what an emergency pot is for, but it shouldn't necessarily be seen as the first port of call. I think everyone should be making those budgeting cutbacks first, cutting back on the things that they don't need, trying to reduce the cost of their essentials before they dip into those savings and investments, because particularly if the money is invested, spending that bit of money now can have really long-term implications. And then the final thing is to just think about the female angle. We obviously know in the UK there's a very big gender investment gap, and there's a big pensions gender gap, and so it's about preserving that and trying not to make that worse. Women already have less money than men when it comes to their retirement, and they live longer, and so it's really about preserving that money that they are paying in and making sure that the cutbacks they make in this cost of living crunch now don't have an even bigger impact on their wealth in the future. Thanks very much for joining me. I hope that was helpful. I'll see you soon.